Welcome back to my channel. Today, we're diving deep into a fundamental aspect of personal finance, comparing savings accounts versus checking accounts. This might seem like a straightforward topic, but understanding the nuances between these two types of accounts can significantly influence your financial strategy. So whether you're saving for that dream vacation or managing your day-to-day expenses, stick around as we explore the key factors you should consider. Let's get started. First up is liquidity. Liquidity refers to how quickly and easily you can access your funds without significant penalties or loss of value. When we think about checking accounts, they are designed for everyday transactions. You can deposit money, withdraw cash, and write checks all without any limitations. Essentially, your funds are readily available when you need them. On the other hand, savings accounts also offer liquidity, but often come with certain restrictions. Most savings accounts allow you to withdraw funds easily, yet federal regulations may limit certain types of withdrawals to 6 per month. While this restriction may not be a deal breaker for everyone, it's something to consider if you anticipate needing regular access to your money. So in terms of liquidity, checking accounts take the crown for immediate access, while savings accounts are slightly less accessible but still provide reasonable flexibility. Now let's discuss accessibility. Checking accounts usually come equipped with debit cards and check writing capabilities. This means that you can conveniently make purchases or pay bills anywhere at any time. Many banks even offer mobile banking apps that allow you to manage your finances from your phone seamlessly. Savings accounts, while accessible through online platforms and ATMs as well, might not provide the same level of ease for everyday spending. If you need cash frequently or want to make regular payments without hassle, a checking account is typically more efficient. However, keep in mind that many people use both accounts in tandem, using their checking account for day-to-day expenses while funneling excess funds into their savings account to earn interest. Next, let's analyze profitability, the potential for earning interest on your deposits. Savings accounts generally offer higher interest rates compared to checking accounts. This is because savings accounts are intended for longer-term storage of funds rather than active transactions. While interest rates can vary widely depending on the bank and current market conditions, it's important to shop around. Some online banks even offer competitive rates that can help grow your savings faster than traditional brick-and-mortar banks. On the flip side, checking accounts typically offer little to no interest on deposits. The primary purpose here is accessibility rather than profitability. So if earning interest is a priority for you, a savings account is likely the better choice. Ultimately, the decision should reflect your financial goals. If you're looking to grow your wealth over time, consider prioritizing a savings account. Let's touch on risk, something many people overlook when choosing between these two types of accounts. Savings accounts are generally low risk. They're insured by the FDIC, Federal Deposit Insurance Corporation, up to $250,000 per depositor per bank in the United States. This means that even in unlikely scenarios where a bank fails, your money is safe. Checking accounts also enjoy this same level of protection under FDIC insurance. However, there's a different kind of risk associated with them. Spending temptations. With easy access to funds comes the risk of overspending or depleting your balance quicker than planned. It's essential to assess not just financial risks, but behavioral ones too, when deciding which account aligns best with your financial habits and goals. Now let's consider psychological factors. The way we perceive our money can drastically influence how we manage it. Checking accounts may give us an immediate sense of control and availability. It feels good knowing our funds are right there at our fingertips. Conversely, many individuals find it psychologically easier to save money when it's separated from their everyday spending account. Having a dedicated savings account can create a mental barrier that helps resist impulsive spending urges. This brings us to another consideration. Setting clear goals for what you want to achieve financially can dictate how you use each type of account effectively. Reflecting on your habits and tendencies will play a significant role in determining whether you'd benefit more from easy access or structured saving. In conclusion, both savings and checking accounts have their unique benefits and drawbacks. Checking accounts provide unparalleled accessibility and ease for daily transactions, while savings accounts offer better profitability and less temptation for impulsive spending. Ultimately, it's not about choosing one over the other. It's about how both can fit into your financial strategy effectively. I encourage you to reflect on your own financial habits and goals as you decide which account, or combination thereof, will best support your needs. What do you think? Do you lean more toward using one type over the other? I'd love to hear about your experiences or any questions you might have in the comments below. And if you found this video helpful, please give it a thumbs up and subscribe for more content on personal finance tips.